If you stay with me all the way to the end of today's episode, you'll walk away understanding what bonds are, why inflation matters so much to the stock market, why bond prices move opposite of interest rates, and one simple way to finally remember how all of this works together.
Intentional, with the money. What do you do with the money? Make it move, make it make sense, make it make sense. This is rooted, we on record.
This is What the Money. I'm Dr. Cece Anthony, and around here, we don't just talk about money, we make it make sense. Welcome back to episode 3. Today, we're talking about something in the news is mentioning all the time right now, but rarely explains: inflation, bonds, interest rates, and why investors get nervous when bond yields start rising. You'll hear headlines like, "The bond market is flashing warning signs. Inflation could send stocks lower. Treasury yields are climbing." And for most people, that sounds like financial algebra with emotional damage attached to it. But today, we're slowing it all the way down. All right, let's start with what the money. Today's article says investors are nervous because inflation may still be too high, and if inflation keeps rising, it could push stocks lower. Now, immediately, some people hear that and think, okay, but why does inflation make the stock market panic? Let me make it make sense real quick. Inflation simply means prices are rising. Groceries, gas, you feel it. Rent, insurance, travel, everything is costing more. Now, the Federal Reserve, also known as the Fed, tries to control inflation mainly through interest rates. When inflation gets too high, the Fed may raise interest rates to slow spending down. And when interest rates rise, borrowing money becomes more expensive. That means mortgages cost more, car loans cost more, credit card interest cost more, business loans cost more. And when borrowing becomes expensive, people and companies usually spend less money. That slowdown can hurt company profits, which can hurt stock prices. Now, here's where today's article gets really interesting. The article talks about rising bond yields. And bond yields have investors nervous right now because they often rise when investors expect higher interest rates. Now, some people hear the word bond and mentally leave the room, but come back, stay with me, because bonds quietly influence almost everything in the economy. The article explained that inflation concerns tied to rising oil prices and tensions in the Middle East are pushing investors to expect the Fed may keep rates higher or even raise them further. And historically, when the Fed starts raising rates, the stock market often struggles for a while. The article also mentioned treasury bonds. Treasury bonds are basically loans investors like you and me give to the government in exchange for interest payments over time. And here's the key thing: bond prices and bond yields move in opposite directions. That sentence confuses almost everybody the first time they hear it. Don't worry, I got you. We're about to make it make sense. Now, let me put this on record. One of the reasons finance feels intimidating to people is because the industry loves using complicated words for simple ideas. Sometimes people hear treasury yields rose due to inflationary pressures and tightening monetary policy expectations. And they're like, what in the CNBC did you just say to me? Because once you slow it down, most financial concepts are actually pretty logical. And honestly, a lot of people make emotional money decisions because they never learned how the system works. They just hear market crash, inflation spike, Fed panic, bonds sell off, and immediately get scared. But understanding creates confidence, because when you understand why markets react, you stop feeling like money is some mysterious game only rich people understand. That's why education matters so much to me. Not to make people sound smarter at dinner parties, but to help people make calmer financial decisions in real life. All right, let's make it make sense. What is a bond? A bond is basically an IOU. You loan money to a government or company. In exchange, they agree to pay you interest over time. Now let's use a simple example. Imagine you buy a bond paying 3% interest. That sounds great until new bonds suddenly start paying 5. Now your old 3% bond, it doesn't look attractive anymore. So if you wanted to sell your old bond, you'd probably have to lower the price of the bond to convince someone else to buy it. And that's why bond prices fall when interest rates rise. Let me say that again, because this is key. When interest rates rise, older bonds paying lower rates become less valuable. So interest rates up, bond prices down. Interest rates down, bond prices up. Opposites. And here's an easy way to remember it. New bonds become the shiny new iPhone. Older bonds suddenly look outdated. That's why investors demand discounts on older bonds when newer bonds are paying better interest. Now, why does the stock market care so much about bond yields? Well, because higher yields increase borrowing costs across the economy. Businesses borrow money. Consumers borrow money. Governments borrow money. And when borrowing gets expensive, growth can slow down. That's why investors watch bond markets so closely. The bond market is basically the economy's stress detector. You can find the article at the center of today's episode on the feed of my website. This podcast was created for the people who were never taught, but always capable, for the ones figuring it out in real time, for the ones building something out of nothing. This is where confusion gets replaced with clarity, where money stops feeling intimidating and starts feeling intentional. I'm Dr. CC Anthony, and this is What the Money. Thanks for listening to today's episode of What the Money. I hope today helped you better understand bonds, inflation, interest rates, and why the market reacts so strongly to economic news. If you enjoyed today's episode, make sure you like, follow, comment, share, and if you're watching on YouTube, subscribe. All the little things help the algorithm push this content to more people so we can continue making financial education accessible, relatable, and real. And if you have a money question you want answered on a future episode, send it in. Your question may be featured on the show. Stay rooted, grow intentionally. The opinions expressed herein are for general information only and are not necessarily the opinions of Osaic Wealth or its representatives. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation. Securities and investment advisory services offered through Osaic Wealth Inc., member FINRA/SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. Osaic Wealth does not provide tax or legal advice.
Yeah, yeah. Yeah, what the money? What it do? Break it down, make it move. If it's talking, we translate. Make it make sense. This is rooted. Let me put it on record. With the money, yeah, we watching how it's moving. Make it make sense. Yeah, we breaking down the message. Stay rooted. Grow intentional. With the money, what it do? With the money, make it move. Make it make sense. Make it make sense. This is rooted. Nothing moves alone, yeah, it's all connected. Check the pattern, then respect it. What you plan here shows up later. Small steps now turn into acres. With the money, yeah, we watching how it's moving. Make it make sense. Yeah, we breaking down the message. Stay rooted. What the money? What it do? What the money? Make it move. Make it make sense. Make it make sense. This is rooted. We on record. Nothing moves alone. let's improve. Stay rooted, grow intentional. What the money? What it do? What the money? Make it move. Make it make sense. Make it make sense. This is